Imagine waking up tomorrow morning, checking your bank account, and finding out that you simply cannot access your own money. Not because you did anything wrong, not because of a technical glitch, but because the system you trusted your entire life decided overnight that your savings were no longer yours to take. You'd think that's impossible, right? That kind of thing only happens in poor countries, failed states, war zones. Except it happened in Lebanon just a few years ago. It happened in Argentina. It happened during the American Civil War. And if you trace history carefully enough, you'll find that financial collapse isn't the exception. It is, and always has been, the rule. Today we're going to travel through centuries of economic disaster, empires that crumbled, currencies that turned to dust, banks that locked their doors. And by the end of this, you will understand something that most people never learn until it's too late. The patterns of collapse are predictable, and the people who protect themselves are almost never the ones who trusted the most. They are the ones who doubted first. Let's start more than 1,000 years ago in the Eastern Roman Empire, what historians call the Byzantine Empire. After the Western Roman Empire fell in 476 AD, the eastern half survived for nearly another 1,000 years. One of the core reasons it lasted so long was a little gold coin called the solidus. It was minted to an almost obsessive standard of purity, and for centuries, merchants from Europe to the Middle East to Central Asia accepted it without question. It wasn't just Byzantine money, it was the world's reserve currency of the medieval age. Now, if you know anything about Rome, you might already sense where this is going. The original Roman silver coin, the denarius, had been one of the most trusted currencies in the ancient world. But over time, the emperors began quietly reducing its silver content, mixing in cheaper metals, shaving edges, stretching each coin further. It started subtly, a few percent here, a few percent there. By the 3rd century AD, what had once been a silver coin was essentially a bronze coin with a thin silver wash. The currency collapsed, trust evaporated, and with it, Rome's ability to pay its armies, fund its infrastructure, and hold its borders together began to crack. The Byzantines had watched this happen. They had inherited this cautionary tale, and yet, centuries later, they did the exact same thing with gold. Byzantine emperors under financial pressure began debasing the solidus, reducing its gold purity, mixing in cheaper alloys, quietly hoping no one would notice. For a while, no one did, but eventually merchants across the trade routes started refusing the coin or demanding more of it for the same goods. The currency's reputation, which had taken centuries to build, crumbled in a fraction of that time. And with it, the Byzantine economy lost the stability that had been its backbone. The lesson is almost painfully obvious in hindsight. Governments throughout history have always, eventually, been unable to resist the temptation to print or dilute their way out of trouble. It never ends well. What survived the Byzantine collapse? Not government bonds, not paper promises. Merchants who had quietly kept real gold or invested in land outside imperial reach preserved their wealth. Everyone else watched their savings erode in real time without even realizing it was happening. But not every collapse is the slow erosion of trust. Sometimes the shock comes from somewhere no government can control at all. In 1347, a merchant ship docked in Sicily carrying something invisible and catastrophic. The Black Death entered Europe and over the next 4 years killed somewhere between 30 and 60% of the entire European population. Cities that had been bustling centers of trade and culture were suddenly half empty. Fields went unplowed. Supply chains that had operated for generations simply stopped. Now here's the part most history books gloss over. The economic aftermath of the Black Death was not just misery. It was also, for the survivors, something surprisingly close to opportunity. When half the labor force is gone, the labor that remains becomes extraordinarily valuable. Landowners who once had dozens of serfs working their fields suddenly couldn't find enough workers. And the workers who remained knew it. Wages rose, peasants could negotiate, and land, which had once been impossibly expensive, could be bought for almost nothing because there was far more of it than there were people to farm it. The families and individuals who came through the Black Death with liquidity, silver, goods, or even just the physical ability to work and trade, found themselves in a buyer's market for land and property on a scale that had never existed before. It was a brutal, horrifying way for the social order to shift, but shift it did. Sound familiar? During the COVID-19 pandemic, we saw a compressed modern version of exactly this dynamic. Governments around the world printed trillions of dollars to keep economies from collapsing entirely. Supply chains buckled. And what happened? People with capital and liquidity bought assets, Homes, stocks, businesses at prices that seemed high at the time but would look like bargains within months. Meanwhile, people living paycheck to paycheck fell further behind. Not because they were less intelligent or less hardworking, but because they had no reserves to absorb the shock and no liquidity to act when opportunity appeared. History rhymes with uncomfortable precision. Crises redistribute wealth. They always have. And the redistribution almost always runs in the same direction, from those without reserves to those with them. Now, even when pandemics and armies aren't destroying economies, there's another quiet killer that history keeps returning to. Institutions, the kind that look so large and so powerful that it seems impossible they could ever fail. In the 1340s, Florence was the financial capital of Europe. The Bardi and Peruzzi banking families were so wealthy and so powerful that kings borrowed from them like we might swipe a credit card today. And for a while it worked. But when Edward III of England, deep in debt from his wars with France, simply stopped repaying those loans, the consequences were catastrophic. The Florentine banks didn't have the reserves to absorb the losses. They collapsed. And ordinary depositors, merchants, craftsmen, families who had trusted these institutions with their savings, lost everything. Here's the thing about too big to fail. It is never actually true. It is a story institutions tell to attract your trust and your money. In 1340s Florence, the biggest banks in the world failed in a matter of months. In 2008, Lehman Brothers, one of the most powerful financial firms on earth, collapsed virtually overnight and triggered a global financial crisis. In 2019, Lebanese banks froze the accounts of millions of ordinary citizens who had done absolutely nothing wrong. And as recently as 2023, regional banks in the United States collapsed within days once depositors lost confidence. The name and the address change with each century. The lesson stays the same. An institution's size is not your guarantee. Its promises are only valid until the day they aren't. Let's talk about something closer to American history: the Civil War. Most people know it as a moral and military conflict. Fewer people realize that behind the battlefields, both the Union and the Confederacy were running desperate financial experiments that tell us something profound about paper money. The Union government, needing to fund the most expensive war in American history up to that point, issued paper currency called greenbacks, dollars backed not by gold, but by the promise and credit of the United States government. It was bold, it was necessary, and it worked, partially. But inflation followed. The more greenbacks flooded the economy, the less each one bought. Trust in the currency wavered throughout the war. In the Confederacy, the situation was far more catastrophic. Confederate dollars, sometimes called graybacks, were printed in quantities that bore almost no relationship to the actual goods and resources available. By the end of the war, Confederate inflation had reached levels that are genuinely difficult to comprehend. Prices rising thousands of %. A soldier's monthly pay couldn't buy a week's worth of food. Families carried bags full of bills to purchase everyday items. And by 1865, Confederate currency wasn't just weak, it was worthless. Completely, entirely worthless. What mattered in the wreckage? Land, food, gold, anything tangible. People who had converted their savings into hard goods before the collapse retained value. People holding paper promises watched those promises turn to ash. This isn't ancient history. This is American history. Your own country has already lived through a currency collapse. And when it happened, what protected people was not faith in paper, but ownership of things that paper cannot replace. France gives us another version of this story, arguably even faster and more dramatic. In the 1790s, as the French Revolution toppled the monarchy, the new government needed money. They came up with a creative solution. They would issue paper currency, assignats, backed by the value of land and property seized from the church and the aristocracy. In theory, it was clever. In practice, it was a disaster, because the revolutionary government kept printing, and printing, and printing again. Each new wave of assignats diluted the ones already in circulation. Prices spiraled upward. Wages couldn't keep pace. Farmers refused to accept paper money and demanded silver or goods instead. In Paris, bread riots returned. The revolution that had promised liberty and equality delivered instead a currency so worthless that people burned it for warmth. The winners were those who held food, gold, or property. Things no printing press could replicate. The theme that runs through all of these stories, Rome, Byzantium, Florence, the American Civil War, Revolutionary France, resurfaces with even greater clarity in the 1997 Asian financial crisis. Thailand had borrowed heavily in US dollars, confident that its currency peg would hold. It didn't. When the Thai baht collapsed under speculative pressure, the cascade was almost instant. Indonesia, Malaysia, South Korea, the Philippines, currencies across Southeast Asia went into freefall. The people who suffered most weren't hedge funds or international investors. Those players, in many cases, made fortunes in the chaos. The people who suffered were ordinary citizens whose savings lost half their value overnight, whose mortgages doubled in local currency terms, whose jobs evaporated as businesses collapsed. Meanwhile, international investors moved in to buy Asian assets at fire sale prices. What looked like a regional financial crisis was, in reality, a massive transfer of wealth, from people trapped in local currencies to people holding dollars and assets abroad. The lesson the crisis exposed is one of the most dangerous traps in modern finance. Debt denominated in someone else's currency is an invisible time bomb. When the storm comes, the debtor drowns. The creditor gets stronger. And then there's Lebanon, perhaps the starkest modern example of everything we've discussed. Between 2019 and 2021, Lebanese banks did something that genuinely shocked the financial world. They froze depositors' accounts. Citizens who had spent their entire working lives saving money, doctors, engineers, retirees, teachers, walked up to ATMs and bank counters and were told they could not access their own money. The Lebanese pound lost over 90% of its value. A lifetime of savings became almost worthless in the span of months. People held protests outside banks. They begged. Some broke in. It didn't matter. The people who survived this with their wealth intact were those who had either moved money abroad before the crisis hit, held real assets like gold or property, or kept cash outside the banking system entirely. Everyone who had trusted the institution fully, who had played by the rules, saved diligently, and believed their money was safe, was wiped out. This is the pattern. This has always been the pattern. So the real question isn't whether you find these stories interesting. The question is what you actually do with them. History is remarkably consistent in what it rewards. It rewards diversification, not keeping all your wealth in one currency, one bank, one country. It rewards tangible assets, gold, land, property, things that cannot be inflated into irrelevance. It rewards liquidity, the ability to act when others are frozen. And perhaps most importantly, it rewards skills. Real, productive skills. Because here's something people often miss in these stories. The survivors of history's collapses weren't only those with gold coins hidden under floorboards. They were also the baker who could still feed a neighborhood when currency collapsed, the blacksmith who could repair tools when trade stopped, the farmer who could grow food when supply chains broke down, the merchant who could move goods across borders when local markets failed. In every crisis, money loses value, but production never loses value. People still need to eat, to build, to heal, to move. And those who can meet those needs don't stay poor for long. The deeper protection is this combination: real assets, real skills, and the habit of questioning systems that everyone around you has decided to blindly trust. Because that's the real story underneath all of these historical disasters. It wasn't that people didn't have warning. Byzantium had Rome as a warning. Florence had other banking collapses to learn from. Lebanon had Argentina. The United States in 2008 had countless financial crises stretching back centuries. The warnings are always there. The pattern is always recognizable. What separates the people who survive from the people who lose everything is almost never intelligence or luck. It is awareness. The willingness to look at the system around you and ask, what happens if this breaks? How exposed am I? What would I do tomorrow if the bank didn't open? Every collapse in history has been a transfer of wealth from the many who trusted completely to the few who prepared quietly, from paper promises to tangible value, from passive faith to active ownership. History doesn't repeat exactly, but the underlying human story of governments diluting their promises, institutions protecting themselves first, and ordinary people bearing the cost, that story doesn't change. It is playing out somewhere in the world right now, and the only real question is whether you are positioned on the right side of it when it does.